Greetings, everyone. I'm David Darst. Thank you for joining us today, mid-May. We hope you're having a good start to May. Last week in the U.S. equity markets, the S&P 500 was down 3.2% on news from China, economic news, COVID shutdowns, and so forth. I would note, by the way, that they have said that if Friday, May the 20th, if the COVID cases, they might be opening up the economy somewhat. And I think that's one of the three conditions that we say you will need to see. The second would be the Fed feeling that they're conquering inflation, and inflation is going to go down from its very high level. Last week was all about inflation, as you know, the consumer price index and the producer price index. Year over year, the April consumer price index was up 8.3%, and year over year, the wholesale price index or the producer price index was up 11.0%. These are the highest inflation numbers that have been seen in a decade. So first is you need China. And look, the market's oversold right now. The stock market is oversold. The bond market has recovered somewhat because interest rates actually went down last week. The 10-year was down 19 basis points to 2.93, and the 2-year was down 11 basis points to 2.61. So far, that having been said, it's very strange with the interest rates going down. You would expect the dollar to go down, but the U.S. dollar, both by the index of 6 major currencies as well as the broader Wall Street Journal index against 16 currencies, that rose last week by almost 8%, and it's up almost 9% this year. Of the 9% gain for the DXY index, 5 percentage points of the 9% came in the month of April. So first, you need China to be easing off on the shutdown. Secondly, we need the Fed to be feeling that inflation is decisively headed in the right direction. We are not so sure that condition has been reached yet. And of course, the Russia-Ukraine conflict, you need to see that maybe beginning to ease up, maybe some sort of ceasefire, peace talks. I don't know. And if that did happen, you would expect the market to rise significantly. Oil prices down, the dollar down, interest rates might actually go down a little bit. Excuse me, if you did have a cessation of the conflict. So those are the three things. Last week, the S&P 500 was down 2.4%. It's down 15.6% thus far this year. With the big declines, of course, have been in many of these meme stocks and stocks with low earnings and longer-term projections. And the big five, this is Amazon, Apple, Microsoft, Alphabet, Facebook, all of them are down double digits. They're down more than 10%. Apple's down 17% for the year. Facebook is down 41%, and everything else is in between those two. The NASDAQ index is down 24.5%, so it's in a bear market. Again, what's the medicine going to be like that the Fed is administering to the economy? And before we wrap up for today, remember there are 6 Feds. There's the interest rate Fed. There's the balance sheet reduction Fed, There is the speaking Fed, talking about moral suasion. There's the stock and bond market Fed, and we're watching carefully junk bonds. The spreads between junk bonds and treasuries have started to widen, and that's indicative of pain coming in the high-yield bond market. The stock market, the currency market Fed, and, of course, the oil price Fed. And with oil last week closing in the United States at $110.89. That is another form of depressant, and the dollar high is another depressant on inflation. So we will see how these 6 different Feds play out in the weeks ahead. But right now, the market looks oversold. This week will be all about two very important indicators. That is the Philadelphia Fed Manufacturing Index and the New York Fed Manufacturing Index. We will see whether, and we'll be looking at the price component of those indices to see whether inflation and whether the Fed's tightening is beginning to have an effect on manufacturing activity. You'll get leading indicators late this week. You'll get housing indicators this week. And with that, we wish everyone a great week ahead and look forward to catching up with you very soon. Thank you for being with us today.